the core structure is a weekly meeting with every property manager at every asset. And if we have one property manager on a couple assets, we'll have two separate meetings where we're drilling down on everything related to the management of that asset. We're looking at target rents, target occupancy, target collections, target expenses. How are we doing against those? What are the real financials showing us? And then what do we need to do to get to where we need to get?
Hey guys, this is Julian Castle, and today I have another episode of A-List Conversations, and I have a big guest on. His name is Tate. Tate is a multifamily investor. He has 743 doors, assets under management of around $80 million. And he's going to be talking to us about his journey, into becoming a multifamily investor. He lived in Salt Lake City. Now he's in Mexico, but he invests mostly in Oklahoma City and Columbus, Ohio. And he does have a podcast that is called The Apartment Gurus, and he has a coaching program as well. So we're going to get into it, and we're excited to have you on. How you doing, Tate?
Great, man. Julian, so good to be with you. I don't know that I've ever officially been in an A-list conversation before, so this is an upgrade for me, man. I'm
amazing,
excited,
man. Yeah, well, welcome to the A-list group, man. You made it.
I love it.
This is what it feels like. And so I really want to get into the conversation here. I want to see, tell us about your journey into real estate. What led you to co-found Greenlight Equity Group?
Yeah, great question. And yeah, like so many things, I think the progression of our lives and our careers, and as entrepreneurs, especially, you can kind of go back a long ways, right? And so, but I'll keep it real, to the point, and get to where we are today as quickly as possible. But originally from Cincinnati, Ohio, moved to Salt Lake City, Utah 24 years ago to be a skier. I was a professional ski photographer for 10 years and a wedding and portrait photographer. That was my first venture into running my own business, owning my own business, being an entrepreneur. Stumbled into single family real estate investing in 2006. And, think about 2006. That was pre-smartphone, pre-podcasting, pre-YouTubing. I think YouTube actually was around, but not like anything like it is today. So not much in the way of idea, thought leadership type stuff, but I did enroll in a local class with a local guru, I guess, and realtor and an investor. And learned the real basic game of single family, mostly maybe duplex, fourplex, but mostly single family flipping. And did that so that was 2006, did that for 2-3 years until the crash. I guess, maybe 2 years until the crash, but never really hit a stride. I got my realtor license during that time. I was doing my own deals and working with some other investors, and we were, back then, the part of what caused the crash was the stated loans and, the weird loan products that we'll likely never see again. But that was really our funding source on what we were up to. And so when those went away, it was pretty easy for me to kind of walk away from real estate in general at that point. I wasn't loving it. It never really got in the groove for me. And then, went back to photography, did a few other business things. And then my best friend, original boss in photography and business partner in photography, he's a real handy guy as far as remodeling and mechanical skills, all that stuff. He approached me and said, I've got some money sitting around. And at that point I had some too. And he's like, what would you think about flipping some houses? And I'm like, dude, I never want to do real estate again. And so fast forward, a few months, we're into our first flip. This was like October of 2011. So obviously I came around on it. Back, 2011 was still like, we were in the wake of the 2008 crash still 4 years later. And so values had not come up at all. And housing in Salt Lake at the time was incredibly affordable, literally 20% of what home values are now. And so we just started flipping houses kind of the best that we knew how, and it was something that I embraced full time. And that we thought the smart thing to do at the time was to use all of our own money best we could, and use all of our own time and skills the best we could. The concept of leverage and building a team and systems was just not really on the radar yet for me. Looking back, that's kind of amazing given where I am now. But so essentially what we ended up with was doing 4, 5, 6 houses a year, and not having a whole lot of fun with that, to be honest. I mean, we were successful, but when you're making 20, 30, maybe 50, 60,000 a flip, and with a somewhat of a high risk level, especially when it's your own money, and you've got a 3, 4, 5 month turn time. There's some risk in there. It just the risk reward and the work reward ratios just. I was just ready to get out, like 7 years into it. So this was like 2018, ready to be done. So what we did was we started looking for. Well, I'll rewind. Somehow the idea of going to the local real estate investor associations, so the RIAs, right, and almost they're everywhere now. So somehow that hit my radar, and I might have been through our title company. I went to a meeting, and it just kind of instantly was really kind of lit up by being in a room with people that are doing deals, that know what they're doing, are eager to share. And then all the opportunities that come through that networking, really exciting. So I, heard a guy speak one night who was doing some local development projects, and then also met another guy who we ended up partnering with on some land entitlement deals. So in the next 2-3 years, we did 4 or 5 land entitlement deals, which in essence are buying raw land, going in with the current zoning, going to the city, get it papered for developments, and then selling that papered project to developers without breaking ground ourselves. We did pretty well with those. That's a good model, especially in the right market. And then then we got really bold, tried our hand at building our own stuff, and so we bought a couple of what were single family lots, but had the zoning for multifamily. And we built some luxury townhomes. So think $1 million each townhomes in downtown Salt Lake City. Beautiful, modern, super high ceilings, huge square footage. And long and short of it is we were we were out of our lane big time, and we didn't have the experience to not only to run a project like that, but more importantly, we didn't really know how to do due diligence on the builder and the GC that we needed to do those projects. And we ended up with a bad one. And when I say bad, I mean bad in all the ways, like dishonest, incompetent, disorganized, willing and ready to fleece the budget on the construction fees and everything else. So, and they were awful. It took, the build should have taken a year. They ended up taking 2.5 years, and we lost our butts on them. And it was painful, and it still is painful. When you have something like that happen, it's not easy. There's no two ways around it. However, in the course of that, the same wholesaler that brought us those projects brought us a 12-unit apartment renovation project in South Salt Lake City, which is essentially still part of the urban core there. And it was in an area that was gentrifying quickly, so we had a lot of supportable upside. And we looked at it, underwrote it, and when I say underwrite, like all we had experience with up till that point essentially was like running a flip budget. Here's what you're buying it for. Here's what it's going to cost to fix up. Here's what you're going to sell it for. Here's your profit margin. When we underwrote a multifamily project, all of a sudden you're looking at like income in the underwriting, which to us was just a total revelation. Like, it's like, whoa, like this changes everything when you've got a property that income. And as many of your listeners will know, the valuation on a commercial, this of course above 4 units is a commercial property. The valuation is based on that income. And so you have essentially a lot more predictable exit on that. And so it was just like this mind blowing revelation, especially to me. My partner was excited, but I was really excited. And I caught the vision for investing in apartments, and went to a conference in Denver, 3-day conference where I met some people, some speakers and thought leaders that are still part of my world today. One is one of my very best friends. Another ended up being my coach and mentor in the first, year and a half of our existence and progression. And kind of the rest is history. And so that was about 5 years ago. It took us about a year for me to get to the point of knowing the business and feeling confident enough in the business to start chasing properties. Our first market was Columbus, which is 2 hours from where I grew up. We loved Columbus at the time for a number of reasons that I could get into, but we just dug in, started touring properties, started making offers. Of course, it was all out of state, so we had to learn how to do that. And in 2021, we, in December of 2020, we were into another property in Utah, which is a 20 unit, right? So that came after the 12 unit. But other than that, we had the loss still in place on our balance sheet from those previous projects. So you could essentially say we started from nothing or even less than nothing. And by the end of 2021, we had about $50 million in properties under ownership with, my partner and I, with a couple of kind of key general partners that we brought in and investors. And then we did start 3 of those were syndications, and that became our model, the syndication model. And so it was a really rapid growth curve. We bought some properties that were heavy value add, Class C, pretty rough type properties that have quite transparently not turned out very well. And that's something that we could talk about, the hows and whys of that, and kind of especially now where we are in the market with those now. And I guess one of the things that I think is super important is my mentor that I mentioned that kind of got me started early on in a group coaching session. There were 15 of us there, and he looked at all of us and he's like, every single one of you should have a podcast. And I'm like, okay, well, I'm paying this guy a lot of money to tell me what to do. He just told me what to do. I'm going to go do it. It wasn't super exciting to me. I saw the big compelling reasons to do it, but as far as like whether it really called to me, it wasn't super. It felt more like this is going to be kind of daunting and a little bit hard, and it's not something I'd ever done anything like before. But I did it. I launched it, and within 2-3 episodes, I loved it. It was like, holy crap, this is the creative, intellectual outlet that I didn't have, that I didn't know I was missing, but it's awesome to have it. I guess 4+ years later, it's like you said, it's the Apartment Gurus, and it's all interview based. And so I've had 250 really high level entrepreneurs in the space come do it, and I spend 40-50 minutes easy with each one. So that became that added this whole new level of meaning and kind of enjoyment and purpose in terms of delivering value to the industry and other investors. And then about 2 years ago, I guess now, I can't even remember how this one hit my radar, but I started coaching other entrepreneurs, kind of startup, guys either coming from single family or W-2, getting into the commercial space as lead sponsors or general partners. Started coaching one-on-one, and then started a group mastermind. And that to me was like, as much as the elevation of the podcast was for me in terms of meaning and purpose and enjoyment, the coaching and mentoring and partnering eventually with my guys, and they ended up all being guys for some reason, but that's just been 10x easy in terms of enjoyment and meaning and purpose. And so here I am at age 51, and I finally found my groove, if you will. And it feels awesome. There's just complete alignment with me personally in terms of what I'm doing. I'm really, really on point, and as excited as I've ever been about all aspects of what I'm doing. So So yeah, that's kind of the quick
Yeah,
thumbnail version, if you will.
that's amazing. Congrats on all of that. Yeah, that's
Thank you.
incredible. And I know that multifamily investing is a lot on the passive investing side for a lot of people. So
Yep.
if you don't mind, would you mind, explaining the basics of passive investing for those that are listening, the investors in
Yeah,
the room?
you bet, you bet, you bet. And so we are lead sponsors. So we go find the deals, we do the due diligence, and of course, there's a lot of infrastructure that we have to have in place to even get to that point, as far as our building our brand, our reputation, our online presence, et cetera, et cetera. And then
Yeah.
broker relations. So we source all of our deals from brokers, institutional quality assets, and higher unit count and newer vintage, good amenities, and then the syndication process brings in passive investors that you just mentioned, Julian. So we go out when we're buying a property, we get debt. We got usually a bank. Although there's other sources of senior debt that we can source, and that typically early when we started we could get up to like 80%, loan to value, loan to purchase. As the credit market has shifted sharply recently, that's more like
Yeah.
65 to 70%. So that remaining 30-35% to get of the capital stack to get to the purchase is capital that we bring in from passive investors inside of our network that we kind of have ongoing relationships with. We're constantly building that network. We have like an investor club that that we educate, nurture, kind of have ongoing relationship with, and of course it's a CRM. And so basically those passive investors are, in my opinion, I've said this for years, that's the creme de la creme position in these deals. So
Yeah.
they get a preferred return. Is structurally the way these deals are built. They get an ongoing preferred return as cash flow from the asset allows. Is usually 7 or 8%. So, and they get that every quarter. So that's 7-8% on their investment amount, and then they get
Yeah.
a 70. We've done both a 60-40, 70-30, and sometimes an 80-20 equity split, where the limited partners have the majority of the equity in the project as well. So any additional profits above the pref, let's say 70% and a 70-30 split, goes to them. And then on disposition or refinance, any profits and cash out, 70% goes to them. And all they're doing, their only role in the deal is signing the private placement memorandum and the operating agreement, and deploying funds, entrusting us with the management and the execution of the business plan, and then of course making best decisions around disposition, and letting us do the heavy lifting on really all other aspects. And then they're, at the end of the day, we hope we're producing a really good win for them. We try to do deals that are somewhere between, say, 14-15% IRR, and I'll explain that in a minute. But so so say 15 to 21% internal rate of return, and that's an for those of you who don't know that term, it's basically a return metric that factors in the profit you're making against the time that it takes to get there. So I guess a more simple way of explaining that is we usually do a 5-year hold model, and that within that 5 years, we're aiming for a 2x equity multiple. So if you invest 100, after 5 years, you're going to get your initial 100 back plus another 100 in profit between ongoing cash flow throughout the hold and profit on the disposition. So our deals are 506C exemptions with the SEC, meaning that the practical implication for our passive investors is that they have to be what's called an accredited investor, which means that you have to have a net worth of over $1 million, not including your personal residence, or an annual income of at least $200,000 as an individual. It changes for a married couple. So you have to qualify, right? We can't bring in just anybody into the deals. But so yeah, I mean, it's for us, it's always been about serving our investors and serving the residents of our community. Like, we know if we take care of those to groups of people inside of our investments and our projects that everybody's going to win. So that's
Yeah.
the passive investor opportunity. Yeah.
Yeah. That's amazing. And uh, how does a multifamily syndication work? And what should passive investors look for in a syndication deal?
Yeah. Yeah. So as far as how it works, I mean, I kind of went through that. It's passive investors deploy capital to meet what we call the equity requirement, which is the bridge between the loan amount and the purchase price. And then of course any improvements are usually added on top of that, right? So, on a $10 million deal, let's say we're raising 4 to 5 million, right? From our passive investor network. They fund that part of the deal as the limit. We're called general partners, GP, lead sponsors, another word, or sponsorship group. We do everything. We run the business plan. We work we use third party property management for our properties. So we're heavily involved in what we call asset management and making sure that the property is performing, meeting our target metrics, KPIs, and then just doing the best we can on strategically exiting when appropriate. And that's essentially it. There's some SEC aspects of this that we could talk about, but those are a little more technical. So does that kind of answer that part of that question for you, Julian?
Yeah, for sure.
Yeah. And then I'm sorry, remind me that you had a follow up there as well.
Yeah, the follow up was what passive investors should look for in a syndication
deal.
Right.
Yeah, perfect. Great question. So for me, it's you're betting on the jockey largely, and of course you want the best horse too. So the horse is the deal, the horse is the asset, or the fund. That's another thing that you can invest in as a syndication, as a passive investor, where not to complicate things, but a fund manager will have a fund that they syndicate passive investors into, and then they'll go out and invest in multiple deals through that individual fund, right? We're actually transitioning to that probably in the next year, but up till now, we've had, as we've acquired properties, we'll offer that opportunity out to passive investors, and we'll provide an offering memorandum with all of our projections, everything there is to know about the asset and the market. We'll do a live webinar. And then, of course, once they're enrolling, there's legal docs that are the further description of the asset, the deal, the structure, the risks, the team, et cetera. So first and foremost, you're betting on the jockey, like I said. So you want to really vet the team, the general partnership team. By vet, I mean you want to check out their track record. You want to look at their social media accounts. You want to do a Google search. Some people do a background check, all that stuff. But you want to just make sure that there's a lot of alignment and confidence with the team first and foremost, because you can have the best asset in the world with incredible existing financials and amazing track record and occupancy, and if you have the wrong team doing the deal, you're likely going to lose anyway. So first and foremost, it's the team. And then, on deal level due diligence on the passive side, it's kind of up to the individual passive investor. And it also depends on how savvy you are with understanding a commercial asset with, P&L statements and, forecasts and return metrics. And so some of our investors will dig pretty deep and get a pretty global understanding of the actual asset and the deal and our business model. And of course, we present all of that in writing and in our offering memorandum and in the webinar, and those go hand in hand. But it really varies on the asset level due diligence. And my recommendation, of course, is you want to know as much as you can about what you're investing in. It's an investment. There's always risk. There's always a chance of loss. And so, our documents and our marketing materials we try to be very transparent in terms of those potentials. And if there's any pitfalls that I have identified as potential concerns, we'll share those. I will say in this market, we're really sourcing like pretty risk mitigated assets, in place cash flow, current profitability, et cetera. But 2 years ago we weren't. We were buying deals that were distressed and largely vacant in a lot of cases, needed a ton of physical work. So nothing even close to in place cash flow, but we had a business plan to improve the property and get to in a lot of cases very high level returns. But again, total different risk level and total different business plan. So so that's I'd say first and two things. If you're a passive investor and you're not familiar with this, we call this an alternative asset or an alternative investment opportunity. It's not hard to get your head around what it is, right, and how it works. And most of us all understand real estate and the inherent value of real estate and the amazing historical consistent track record it has of value growth. And then of course, when you're buying properties that are cash flowing and profitable while you own them, ideally you're profiting during the hold, and then you're profiting significantly on the disposition. So first and foremost, do your best to get as comfortable as you can with the whole that asset class that you're the game that you're looking at getting into, and then align yourself with a sponsorship team or a sponsor. In my case, I'm Greenlight Equity Group. I'm basically president, CEO, founder. So in my case, you'd want to get to know me very well, and then my partner Terry Bailey as well, and just understand everything you can about us. And that's not hard to do these days, right? You Google search somebody, and in my case, I'm on LinkedIn, Instagram, Facebook. I've got a podcast. I've got a YouTube channel. So hopefully you can get a really good feel for me and how we do things. And that's going to be true of just about anybody in this space that's doing big things. So that's those two steps I think are the most important.
Yeah, that's amazing. And so what resources or tools would you recommend for passive investors to better understand multifamily investments?
Awesome question. Really, really great question. I mean, YouTube University is just, there's nothing like YouTube. Actually, if there was one message, like aside from anything real estate related, that I would encourage your audience to take away from is, like, really, if you're not already, get your head around what a wealth of resources, knowledge, ideas, practical application that's in YouTube. Humanity has never had an assemblage of knowledge, wisdom, et cetera, in one source, in one place, anything close to what we have on YouTube, right? And I just think that it may not sound super relevant, but to me, it's like one of the most powerful tools that we all have access to. Pro tip: get the premium account. You lose the ads. You can build libraries. There's some really, really key premium features. You can start a video on your phone and have the audio go on and be doing other things on your phone or whatever. You can download. So anyway, a couple of years ago, my answer probably would have been a little different than this, but to me, I kind of start everything these days in terms of research processes and brainstorming with YouTube searches, because whatever you're up to, somebody's already done it. And if you need to learn something, somebody's put a resource out there to learn from it. And in most cases, there's really powerful thought leaders and influencers that specialize in exactly what you're talking about. So start with YouTube. There's some great books out there for passive investors in particular. I don't have an actual book. I'll go ahead and throw a few references to some colleagues that I love. Joe Fairless, Fairles. Fairless, just like it sounds, has an awesome book on the kind of the ins and outs of real estate syndication. My buddy Matt Faircloth is another one. But again, Audible, right? Kind of similar sort of database for great audiobooks if you want to approach it from that angle. You can go ahead and go to my landing page, which is actually in full transition. We're about to relaunch, but our current version's great. So that's investwithgreenlight.com. And then I'll just throw this out there. I have a Calendly link on that you can find through my landing page, and I will gladly jump on a 10, 15-minute call with anyone that wants to just unpack this a little more and talk about what their individual thoughts, needs, questions, goals, et cetera are. No strings attached. I'm in that regard, I'm always here to serve. That's why I do the podcast, why I do this sort of thing with you and coach, right? So I'm in it to, I'm a very, very strong believer in the more people I can make wildly successful, that's really all that matters. And I have so much confidence in that I won't even finish that sentence with like, I know I'll be successful, because it's just a given to me. So it's like, I've got a very singular focus on value add and helping people out any way I can. So yeah, happy to help individually as well. So yeah.
That's amazing. Thank you so much. While doing my research, I did find that you have quite a different take on the way you do, value add. And then this really comes into as community transformation.
Yep.
I really would like to get some real life examples of the community enhancements that you've achieved, working with these properties, and all that.
Yeah, I mean, I think I owe it to you and your audience to be as honest and transparent with this answer, and it's probably not what you're going to expect. So, our first, let's say, certainly our first 3 acquisitions, and then let's say the next, let's say 2 out of 4 acquisitions. So, our first, let's say 4 or 5 acquisitions out of 6 or 7 were Class C distressed value add projects, most of which needed big time physical CapEx budgets to go in, renovate the units, renovate common areas, and then turn the tenant base, right? So when you take a project like that, that's got, a high level of physical distress and usually poor management, at that point, you've got a tenant base that, God bless everybody. And I mean that, but in a lot of cases, it's not a workable situation to keep that tenant base in there. So the reality is that you're working with management on turning a tenant base over and installing a new tenant base. And my experience with that is it's a little bit like turning an aircraft carrier around. There's an awful lot of resistance and inertia in that process. It's not nearly as easy as it sounds when you underwrite it. It comes down to in a lot of cases, it really comes down to the sub-market that you're in, not even necessarily the asset. And then we've had a couple properties that, just to be totally honest, like, we have not made the impact that you're speaking to. As hard as we've tried, as much capital and energy as we've infused, as many different management options as we've tried, et cetera, it's not easy. And then in addition to that, as the interest rate market has sharply shifted over the last, let's say, 16, 18 months, where we went from essentially an effective interest rate basis of 0-1% to 5-6%. That's a 500-600% increase in interest rates, right? Plus we came out of the COVID economy where people are now not receiving the government income or supplementation, if you will. So the economy's more strained. But what the interest rate thing has done is it has really spooked our passive investors and some of our institutional equity partners. And we do bring in more private, like we call private equity sources, that write bigger checks to invest with us on bigger assets. So at this point, Julian, the Class C heavy value add projects just not in our buy box anymore at all. We don't have any interest in doing those, and that's really first and foremost looking out for our investors, because the risk factor of having a business plan that requires that repositioning, that improvement of going from essentially losing money, having high physical levels of distress, in a lot of cases, a lot of crime, going from that to a stabilized, profitable, way upgraded asset that people would want to live in. There's a there's so many risk factors and just all the moving parts there. Even if you're just looking at the construction aspect, right? Not to mention the lending. So, to do a project like that, you need to fund a large CapEx budget. And so what we were doing, and what a lot of people in the industry were doing 2 years ago, was using short-term, what we call bridge loan projects, or products rather, that funded both the purchase and a portion of the CapEx budget. Those are adjustable rates, and they have short fuses. They mature in 3-5 years, so maybe 7 years. That's a high risk loan right now because of the volatility in the market. So we have adjusted our buy box to a place where we're buying, this new property that we're working on right now. It's a 9-year-old, 2015 vintage, Class B plus asset, been at 95% occupancy or above consistently for the last 12 months plus. Great amenity package, great tenant base, profitability on day one with in-place financials. So it's a completely different model. So I usually love to go down the kind of the higher level, more almost philosophical conversation line. And I'd love to tell you how much of an impact we made on communities, to answer your question. But I think, to be totally transparent, the heavy lift Class C it's been a very tough thing for us. One of our communities in Oklahoma, we had a distress situation with an area next to the property where we had homeless people living. I will say, I think we've added a lot to the overall value of that real micro market, if you will, by doing what it took to secure that property and keep the homeless influence out of, essentially out of there at this point, and which helps everybody. It's what everybody needs. So we have done some good things, and we've done big renovations and remodels. So I don't want to sell us too short. Like we've done some pretty huge lift renovations and remodels, which of course improves the market as well. So I wish I could say we're saving the world, and hopefully we are in some ways here and there. But again, going back to the focus on our priority is the well-being and success of our investors and our residents, right? Like you mentioned, we have 743 units. That's 743 families or individuals that are directly counting on me, ultimately, because the buck stops with me, to provide them housing, right? I mean, a very primary need, one of the most fundamental needs we all have. So to get that right, there's a massive level of responsibility and obligation that I know I have to them, and so for me, it just means bringing my A game all the time.
Yeah, that's great. I love that, and I want to touch on a little bit of the investment selection. You touched on that. You're not really doing more C class property investments, but I just want to know what your strategic approach now to select investments now is.
Yep. So, okay, great question. So at the end of the day, we are sourcing what I call, and what a lot of people in the industry call, like institutional level or institutional quality assets. What does that mean? That means that the traditional banks, particularly Freddie Mac and Fannie, are going to want to do debt on those, and Freddie and Fannie are the best debt products on a stabilized asset. They're fixed rate, they're high. The leverage points are good. The interest rates are as low as you're going to find, essentially. And so that's a big thing. Unit count is a big thing. So the bigger, the better right now. In other words, you have a 70 unit, you're going to get a lot of investing, especially, your kind of retail level investor, your $100,000, $200,000 investor. But when you get to 150, 200, 250 units, all of a sudden you've got family offices and private equity sources that are ready to jump into those assets with, $5-10 million equity checks. So that's a big thing. Yeah. Vintage is a really big thing. You get the newer the property, the you're minimizing your exposure to physical risk, roofs, mechanicals, everything, foundation, the whole 9 yards, parking lots, some of the big ticket items, windows. So, again, this acquisition we're working on now is a 2015 build. So I've got 9-year-old roofs. I've got 9-year-old air conditioners and furnaces. Like, that's taking another risk factor off the table for us. Cash flow on day one, huge. This is huge. Take the property as it's performing right now. Can you make that work? Can you at least do what you need to do financially, and hopefully get your investors some sort of preferred return? Maybe it's not the full 7-8%. And if you do have a small value add business plan that can get you to 7-8% quickly, that to me is a win. And so, but yeah, we're not doing much at all in the way of rent increase forecasting, even though we're in a great market in Columbus, Ohio, that has really good, strong rent growth. We're not really underwriting that. So we're taking that risk out. And then from there, it's like, things like amenities, sub-market is huge. Like what's around you? What are your comps? What's your competition? When somebody comes to look at your apartment and is either going to sign a lease or not, or apply, what else are they looking at? Right. That's another big factor. So yeah. So, buy box, we call this our buy box. Right. And we have 5-6 qualifications. We love to see assumable loans, like from a year, 2-3 years ago at maybe 3 to 4%. That can be a big win. We look for properties with like a tax abatement, and in Columbus, Ohio, and some of the urban core areas, we're finding that seller financing. So if it's a developer we're buying from that's maybe built the product and they're leasing it up, well, they carry a note for 2 years or 3 years or whatever, even longer. Some of those, I call those the sexy factors. The tax abatement, carrybacks, those the assumable loans. One or two of those can sometimes make a deal go. Can be the triggering, like, let's go factor. But pretty much all the other things have to be in place for us right now as well. I will say this, and again, full transparency, this is actually relatively new for us. We bought a total of 3 properties in 2023. One is our crown jewel. It's a beautiful, kind of modern industrial loft style, huge high ceiling. It's about 80 units in Columbus, Ohio. Amazing amenities, rooftop deck, etc. But the 2 others were heavy lift value adds. One was in Oklahoma, like needed everything. It was totally vacant, 53 units, which is a lot smaller than what we're looking for even back then. But the price we couldn't pass up. But literally roofs, mechanicals, you name it, it needed it. And the pain of that project and the pain of another Columbus value add, in terms of, when I say pain, I'm talking about just bringing the equity together to get the deal closed. It was massively eye-opening to us. It showed us how much the sentiment has shifted with investors, and it's completely informed our new buy box. And now that we're there and we talk about it a lot, and we understand and help our investors understand how much risk we're mitigating and how much of a win we're creating with conservative underwriting with some upside. Like, we're really sold on our model right now, and I feel great about bringing people in as partners, investors, and feel good about what we're doing as far as our own future. So yeah, that's kind of, it's been the shift's happened in, like, let's say the last 8-10 months.
Okay, that's great. And I really want to talk a little bit about how you do, your value add and due diligence on, and asset management. What are some kind of key, unique differentiators that you do that you take to the next level?
Yeah. So I'd rather talk about asset management, I think. And as far as value add goes, it's because it's not something we're currently doing. I don't know that plus I don't really recommend doing it right now. Like, I straight up, listeners, my opinion, just to be real, stay away from Class C, man. Like, unless you can
Yeah.
find a screaming deal with other aspects that secure that you kind of lock down the risk. I'll just say, to me, Class C is risky, man, and it's really kind of mostly tied to the tenant base that you're working with. Which, by the way, this is massively important. The property manager pool that you have to choose from to manage a property like that, if you're not doing it yourself, if you got Class C tenants, you're going to end up with a Class C manager, and that's painful, and that's a reality. We've fired 3 property managers in the last 5 years, and it's expensive, it's painful. A lot of times you're into legal messes, but that tells you how bad things got for us 3 different times, where we had to just say we just had to break, basically fire. In one case, we had to pay a huge breakage fee. But in terms of it, let's shift this to asset management. So, our model right now is, from when we started up till now, is to find the best third-party property managers in the market that we can find to bring to the property, have them manage the property with their systems, their human resources, their reporting, their all their SOPs, KPIs, et cetera. But the asset management, and this is key, and this is like, this is where the rubber meets the road. Like, again, you can have a great deal, you can even have a great team, but if your asset management skills, knowledge, and systems aren't there and aren't intact, nobody's going to make money, and in fact, you could lose money in this market. So, asset management is massive, and it's something that isn't super sexy to talk about, but for us, it's basically the core structure is a weekly meeting with every property manager at every asset. And if we have one property manager on a couple assets, we'll have 2 separate meetings where we're drilling down on everything related to the management of that asset. We're looking at target rents, target occupancy, target collections, target expenses. How are we doing against those? What are the real financials showing us? And then, like, what do we need to do to get to where we need to get? And it couldn't be more critical, to be honest. One way around this that a lot of people, not around this, but one way of like kind of integrating this whole aspect is self-management, right? And kind of there's a lot of schools of thought about that. We've opted to kind of use the third party manager as a leverage point, so I can lean on a third party manager, and when we're not getting what we need, I can, there's an accountability there. The obviously the contrast to that is in-housing that, hiring your own staff, hiring a regional, hiring on-site people, having your own systems and processes. You have more control. There's no doubt about it at that point. But there's a efficiency of scale that's needed to really make that work. And it's, a lot of people say it's around the 1,000 unit count. So we're getting real close to being there. I don't love the idea of going vertical with property management. I would need to bring in the human resources in my team, so to keep my hands essentially out of that piece. I'm happy to asset manage, but I'm not interested in running property management myself. I know myself well enough. I know what I'm good at. So that's really the kind of the overview, the kind of the big picture overview of asset management. There's some, again, like I said, thought leaders, Facebook groups, YouTube University. If you want to find out how to be a good asset manager, in this case, in the multifamily space, which is what we're in, you don't have to look very hard, and it's not necessarily a complex game, but you need to understand it and you need to do it really well.
Yeah, that's great. I want to touch on 2 things before we wrap up. How's it going with the coaching and mentorship? What are some success stories from some of your clients, that have worked with you?
Yeah, I mean, I won't do it, but it's easy for me to almost get a little bit emotional talking about this because of the just the love that I have for being a mentor, and the sense of or coach is I guess is probably more accurate. The sense of like honor that I feel when somebody that is in it to win it is willing to do whatever it takes to become the next best version of themselves. When they come to me and then they pull the trigger with me and make the investment in terms of, you know, financial investment, energy, time, and then the opportunity cost, right? Because they could go with anybody, they could go with other coaches. To me, that just, it calls forth in me personally like my very, very best. And so like when I'm coaching one-on-one or group coaching inside of my mastermind, it's game on for me, and I'm showing up in ways that in some cases, quite frankly, I didn't even know I was capable of. So it's been this amazing trajectory for me personally. What I think the most kind of the highest level thing I'll say about this is when you get into coaching entrepreneurs, the game of entrepreneurship is, in my view, a holistic game, right? So whether you're doing commercial multifamily or you're doing any other entrepreneurial venture, you know, any other industry, whether it's in real estate or outside of, you know, crypto, whatever it is you're doing as an entrepreneur, to be good or to even be successful, and much less to be like an industry leader and to be your very best, like it has to be a holistic approach across your entire life. And so you've got your professional life, of course, your business, you know, all the things that go into that. But for me, the longer I've done this, I knew this intellectually going into the coaching and from my own experience, but it's, you know, they say it's 80% mindset. I'd actually say it's probably more like 85, maybe going on 90% mindset, because what is most required from my coaching clients and my mastermind clients and anybody that I'm bringing in is you have to have this sense of like being completely unstoppable, like unconditionally unstoppable in what you're doing, and which means being resourceful. It means having a bulletproof mindset. It means having your limited beliefs in check and your imposter syndrome in check. And I'm not going to say eliminated because I don't think that's possible, but you need to have a really good grasp on who you are, what your strengths are, what your weaknesses are, where you could get tripped up, and working on ways to integrate that and kind of get past that. But you just got to bring it 100%. So, you know, when I'm looking at new potential clients and bringing them on board, I just gotta see, like, are you curious or are you committed, right? Like that's what it comes down to. As far as success stories go, you know, quite frankly, this last year and a half has been really, really tough. It's been market wide is what I mean. So finding deals that pencil, it has been grueling. Like it's super, super tough because you've got these owners that for the last the 5-6 years going up into this correction have had this number, or not, you know, set of numbers in their head for what they think their property is worth, and then interest rates, you know, quadruple or whatever, and so the debt costs go way up, and people just can't pay what they think that they're worth. So we've had this lull in the market where sellers' expectations have not adjusted to market realities. So sourcing good deals has been tough, and so you know we've had we've had a lot of success in the space of building brands, building networks, building systems and processes. I've got a great software suite tool that a partner and I have developed for running your entire business on, called Investor Octane, which I'm happy to provide anybody info on. But so we've developed some tech tools. We've had a couple guys quit their jobs, and one guy exited a multifamily property he owned coming into the deal, and we've had some acquisition activity, and we were actually, you know, a number of us are in this current deal that we're onboarding right now. So again, full transparency, right? I have nothing to hide here. I can't point to like all these acquisitions and massive capital raises that we've been able to accomplish, because number one, the assets, getting the asset under control and getting a good deal to pencil and getting that in place has been very, very tough. But then the raising the equity thing has been the best capital raisers in the country that I network with and meet at conferences and have on my podcast. They all say the same thing. It's, 3, 4, 5 times harder, excuse me, to raise capital now than it was 2 years ago. It's just completely changed. So the great thing about this, and this is, I think, super important to understand, and maybe this is like a good takeaway point towards the end here, is if you can do it now, and if you do it now, if you're able to acquire good assets now, and you're able to be successful in building your business, building your system, building your brand, your presence, relationships, which is all of what it takes, you will crush it in the next 2, 3, 4 years. So it's as hard as it's ever going to get right now, I guess is what I'm saying. So and that is not at all the case when we started in the coaching and mastermind space. So it's changed a lot, but as entrepreneurs, we have to pivot, adapt, and what worked yesterday isn't necessarily going to work today or tomorrow. So, and you stay forward focused. You take your lumps sometimes. You lose an earnest money deposit. We've had that happen, and that sucks. But you just you pick up the pieces, and then you refocus and move forward. That whole concept of just being forward focused is a massive mindset piece for sure.
Yep. Yeah, that's important. And the last question here I want to touch on is investors' relations. And it's just, I want to know what the best practices are for communicating with and managing relationships with passive investors. Yep. And you talk a lot about how transparency, how to maintain transparency and how to get, nurture, those investor partnerships,
Yep. Yeah. And again, like, I personally will never claim to have done this business perfectly in any aspect, and so there's aspects of this particular piece that we have improved and are continuing to improve and implement new aspects to. But what it really boils down to, Julian, is just over communication, transparency, and responsiveness, right? And so being proactively providing anything and everything about the property, bad news, good news, no news, like they need to know about it. And then, continued outgoing communication, continued access when they need us or want us. Of course, providing the best technology in the way of an investor portal with a dashboard so they can see their investment and how it's performing and see the financial reports and all that. And then just continuing education and value add through email, direct email communication and webinars and of course, publishing the podcast. But what investors want, they want to know the truth. They want to be in the loop, and they want to feel confident that when they have questions and want to reach out to you or need to reach out to you, that you're going to respond very as promptly or immediately as possible. So, yeah.
Okay, that's great.
Yep.
So I think this is a great time to end the podcast here. Do you have any parting words and do you want to let people know where they can find you?
Yeah. So I guess 2 places. Investwithgreenlight.com. We're in the middle of a relaunch, so that's going to completely change. But we have some good resources on there. We actually our new resource that we're uploading here this week is actually a Chat GPT prompt sequence for analyzing deals and in particular the legal docs that you sign as a passive investor, which private placement memorandum, for instance, that's a 50-60 page document. It's all legal. So for any of us that aren't attorneys and actually specific real estate attorneys, none of us are qualified to understand that. But I would argue ChatGPT prompted right and loaded right will give you an incredible level of understanding there. So we have a resource coming out on that. If you want to, email me directly, I'll get that to you. But and then Apartment Gurus, podcast. You can find me on all the platforms, YouTube, etc. And hope you'll find my Calendly link pretty easily and quickly through the website. It's a thrill for me to jump on one. I love one-on-one conversations and strategy sessions with people that are in it to win it, and want to explore possibilities in this space. Ultimately, obviously, I'm biased for sure because I'm an owner operator, but I love this asset class and I love what it offers, and love talking about it. So yeah, consider me a resource. Anybody, all you listeners, I'm here for you. And I'll just, if I could, just kind of one quick closing point, Julian, is that okay?
Yeah, of course.
Yeah,
Please
yeah.
go
So
ahead.
I don't think the mindset thing can be overstated. We talked a lot about some technical aspects of the business. It's actually usually when I'm a guest, I'm kind of known for some mindset wisdom. Not to yeah, I don't mean that to brag, but that is kind of my passion, right? Because I understand how foundational that is. So to me, and I was in my mastermind meeting with my guys yesterday, I got really real with them, and I'm like, look, you need right now in this business, you need to be in 100% whatever it takes mode to make this happen. You are taking in millions of dollars of people's life savings or capital, family capital. You're investing it in assets that could go south if you don't do it right. And you need to get every part of that process right from soup to nuts. So this is as serious a venture or responsibility, or in my view, it's an honor and a sacred trust that investors place in me, my coaching clients place in me, everybody that chooses to work with me, they're putting a sacred trust in me. But the mindset thing, whether you're passive or active, and no matter if you're in a W-2, if you're in a different business, different industry, like go with that 80% model where, like, if there's something in your life or in your business that's maybe you're looking at as an area that could be improved, start with mindset. Start 100% with mindset. Look for points of inner alignment. Look for anything that's maybe not aligned inside of your core values and how those are being expressed in your life, in the external, so in your business, relationships, etc., and then work on getting aligned, and that's when the magic happens, and I promise you it does. Like when you get that inner alignment piece, life is like, you don't know what you don't know about how good life can get at that point. Not that it's easy. I would never say life, it does, in my opinion, it doesn't ever get easy, but it can get extremely meaningful and purposeful and fulfilling and moving. And so, and I'll close with this. One of my clients, Tom Kirkpatrick, he says the best: lead with gratitude. That gratitude is a secret sauce for me that there's nothing else that touches it, and the context that it creates is second to none, irreplaceable, and it releases all resistance and gets you out of any sort of victim mode or mentality you might be in. You can't be in victim mode when you're grateful. So I'll just leave it at that, Julian. I hope that helps.
Thank you so much, Tate. Yeah, we really appreciate you guys for tuning into this episode with Tate. And, he does talk a lot about mindset. And that's something that's really cool because I've had other guests on and they always say the same thing. They say real estate is 80 or 90% mindset and the rest is the
Yeah.
mechanics. So I would say
Yep.
go check out his podcast, Apartment Gurus, and go check out his website, investwithgreenlight.com.
Yep.
Thank you for coming on, Tate.
My
Have a
pleasure.
good
Thank
day.
you. You too. Appreciate it, Julian.